Let's start with the broader markets. Obviously, one thing that's driving the markets this morning seems to be this news that Russia is considering capital controls. They might introduce capital controls to try to stem the flow of rubles of money leaving the country. What are you seeing play out in volatility?
So what's happening is during September and October, you tend to see volatility peak. Right. So what's happening is it's the end of the quarter. Next month, we're going to see a lot of earnings come out. So you're seeing the market really respond to the volatility respond to the market, because in July, it bottomed at around 10. It's averaged around 13. At 15 here, you're seeing that the market's saying that we're going to have some volatility come in, whether it's geopolitical risk, earnings, or the end of the quarter.
The VIX is the fear gauge. It's
Sure.
supposed to respond to external shocks. Is it really something that is seasonally traded?
Yeah, it is actually seasonally traded. So if you look at December, it tends to trough a lot. It's happened 7 out of the last 25 years. So you're seeing a seasonal trade where September, October tend to be high and December tends to be low, and then it picks back up in January.
Very good note. So even though right now we're about 15.5, that is still historically a pretty low level. Talk to me about eBay. This is a company, a call you've made a lot of money on. You came on 2 weeks ago. Walk us through what your trade was then.
Great. So the trade was to buy the stock around $52 and then sell the $52.50 against it, collect some premium. There was activist shareholders in there, and they actually got what they wanted today.
Yes, it's a very good day for Carl Icahn.
Yeah, it's a great day. So what we're looking at here is the implied volatility is still high. It's above 30. And if you look at the NASDAQ 100, its implied volatility is around 18. So you can actually capture that implied volatility and roll the call up and collect in more premium.
All right, well, congratulations on that, I suppose. You've also got a strategy on Celgene. How are you playing it?
Correct. So the biotech space, people don't grasp really well, right? And so there's a lot of players in there. You get the FDA involved. And so Celgene is a company that has franchise drugs. And so they're already making money. They have a 1 price to earnings growth ratio. So it's a great company to come in and invest in. And so what we're looking at is, given the heightened volatility in October, they also report earnings on October 23rd. You can sell the 92.50 put option and collect 1.5% out to October 17th. So it's a great way to get paid to buy the stock if it dips.
All right, and why is that the right time horizon? Why do you want to trade before earnings?
Right. So I think one of the things you want to do is actually capture the volatility, because it is heightened. So the implied volatility is above its historical, and that's leading into earnings. So you're actually getting paid to take that in. And if you look further out down the curve, it's around the same. So you want to capture it sooner rather than later.
One of the things I was reading about Celgene is they have a drug in the pipeline for Crohn's disease, which could be a rival to Humira, which is a $14-15 billion drug from AbbVie. Talk to me about sort of the fundamental case for Celgene.
Sure. So the fundamental case is great. What they've done is they've actually righted their balance sheet. You see them growing at like 17% year over year. With the drug you mentioned, they're expecting to take that into 20% year over year. And if you look at their gross margins, they're at about 95%. And if you're looking at their operating margins, they're around 50, and they're growing. So it's gone from 47% to 51% on the operating margins. So it can only help improve the story.